the show right now. Mahesh, hi, good morning. Great to have you on the show. Welcome back to ET Now. Hope all things good and safe.
Thank you very much. It's always a pleasure to be back. Yes, all's well, and hope the same with you guys.
Yes, touch wood so far. Mahesh, just looking at the outperformance that India has actually, posted year to date, or for that matter, the last 3 months as well. The PE multiples, yes, they're surely, skirting around close to highs. But is that any reason to worry? Or do you think ride the wave, the momentum is backing us?
Yeah, so to be honest with you, Aisha, it's clearly been a positive surprise for us as well. How India has ended up outperforming despite the second wave and the economic impact. But the good news here is that the economic recovery post unlocking is clearly surprising on the positive side. The whole host of indicators we track, and many of these are like daily data points and weekly data points, which are pretty high frequency in nature, are actually showing that the pace of recovery post the second wave is actually a tad faster than what we saw after the first wave, and which is a big surprise because the first wave economic impact was deeper. It was a national lockdown. This time the economic impact was shallower and step by step by different states. So that's really been a positive surprise. So I think the momentum is back, as you rightly mentioned. We do expect to see reasonable momentum in the near term. But I think if we take a 6-month to 12-month view, a lot depends on global sort of factors, and that makes me a bit cautious from a 12-month perspective.
All right. Mahesh, there's been a lot of churn, of course, as the market continues to try and find opportunity within every pocket, it seems, at the moment. But going forward, what do you feel is really going to be the area to bet on? And I'm thinking past just the argument between cyclicals and the age-old defenses, but something deeper than that. Is there a pocket, let's say, I think most naturally one has been looking at IT, but outside of that you feel is going to be an interesting outperformer going forward?
Yeah, so I do believe that the economic trajectory has bottomed out globally as well as in India. And we are looking at the economic growth momentum definitely looking quite bright over at least the next 12 to 24 months, and hopefully beyond that as well. So that does call for some change in the sector allocation and the stock allocation as well. What has necessarily worked in the last 5 years or 10 years may not work in the next 3 years to 5 years. Because as I mentioned, I think the growth outlook today is looking much better. I think, in the Indian context, we are sitting at the bottom of the, cyclical, economic trends. And from that perspective, I do believe that some of the expensive defensive names, as you mentioned, which have done pretty well in the last 5 years, I would say that they run the risk of underperformance going forward. Whereas some of the cyclical names, be it on the property side, some of the industrial names, would be the ones that would probably be outperforming, going forward.
Since you're tracking global indicators, Mahesh, I can't wonder but ask whether or not you're seeing any danger of a topping out. Some of the technical indicators are pointing towards that, even though sentiment clearly is far from any sense of selling. But are you at all cautious about what this would mean in terms of impact with regards to action in India, which has actually been driven by a lot of domestic investors in the last couple of months? But what's the trend you see going forward?
I think globally, the one variable to watch out for, there are many indicators and what's happening to the DXY, what's happening to the rate outlook, and so many other things. But if you'll ask me, what is the one indicator that we should be looking out for? I would say we should be focusing on the US 5-year inflation expectations. Those have been going up over the last, I would say, sort of 3 to 6 months or so, and naturally, is the case. My sense is that whether the global inflation, the US inflation returns or not, I think what we as an equity investor need to be worried about is whether there will be an inflation scare. And this 5-year inflation expectation would be a good indicator of how close or how far are we from that inflation scare. I think that is one indicator to watch out for. My sense is that the risk that we are running is that there could be an inflation scare, which will cause the global markets to sell off, and obviously the emerging markets in India will also not be spared. So that is the one risk that we need to keep in mind from the global perspective. From the Indian perspective, clearly the 10-year bond yields, the risk-free rate has been held down and managed quite well by the RBI. But if you look at some of the other non-benchmark yields like 15-year, which is now, by the way, has become more liquid than the 10-year yield. So clearly, I think the true indicator of what the yields are is the 15-year, in my view, and not the 10-year. So looking at those things, it's quite obvious that as the economic growth in India recovers, RBI will be going a bit slow, on liquidity infusion. Currently, there's a lot of excess liquidity that will probably begin to come down. The yields will begin to go up, and the risk-free rate going up would mean that theoretically there should be some market derating. So that's what I meant. That when I look at the market from a 6-month to 12-month point of view, I do see the risk-free rates in India going up by 50 to 75 basis points, and that will cause the market, derating in terms of PE multiples. Thankfully, we are, in the middle of pretty strong earnings growth, so the market PE multiples going down can get offset to a large extent by the earnings growth that we are witnessing. But I would say from the 12-month perspective, one should not be budgeting for, let's say, more than single-digit returns.
Mahesh, just to the point that you were earlier making about sectors where you see visibility coming in the more near term, with the current market and the kind of valuations that we're currently quoting at, what's the dictating factor? Is it growth visibility or is it valuation?
Yeah, I think, I would say both, but I think clearly the globally and, also in India, the strategy that we clearly like is that of, value. So we clearly have a value bias, in the selection of stocks and sectors. And, clearly we are looking at, the segments where, we have seen big underperformance because of the earnings growth related reasons or the economic reasons. So, therefore, as I mentioned, from the near term perspective, housing market recovery is something that we continue to be very bullish on. You would remember that we've been talking about it for the last 3-4 quarters now. The housing market recovery was shaping up quite nicely before the second wave hit us. And now, once again, we are looking at the trends, and trends are picking up. In fact, if you look at the June month property registration data for Mumbai, for Delhi, for the Maharashtra as a state, and I'm sure that's the case in other markets as well, other states as well, but unfortunately, we don't really have data for that. So in all these 3-4 markets, we are seeing that the June registrations, and the month is not over as yet, is already more than what we saw in June 19. So I think the trend of the housing market recovery, which was visible before the second wave, is now beginning to be visible once again. And that's one segment of the economy which we are very bullish about. And obviously, there are multiple ways to play that through the stock market. One is obviously the property developers, but then there are the other related themes as well, like cement, building material, housing finance companies, etc.
Right. Mahesh, do you think a large part of the prognosis of the housing market recovery is also based on the assumption that interest rates are going to continue to remain low?
Not exactly. See, the interest rates have come down from, if you look at the last 5-6 years, the mortgage rates have come down from 11% down to now about, say, close to 7%, or maybe slightly less than 7%, as we speak. So 25, 50, or even 100 basis point jump in the interest rates or mortgage rates is not really going to have, much of an impact, on the housing market recovery. So I don't think that really is the key factor. I think the key factor, according to me, is going to be how the demand supply situation unfolds and how the pricing situation unfolds, because ultimately it's one of the single biggest investment that anybody makes in his or her lifetime, and everybody wants to time the market. And I think the biggest driver for property demand, in my view, is the price momentum. So if we begin to see the property prices going up by 5%, 7%, 10% kind of a number, there's a lot of pent-up demand, and a lot of people who have been postponing, the purchases for a long period of time, would jump in. So no. So to answer your question, interest rate going up by 50, 100 basis point won't really have much of a negative impact. The pricing momentum, I think, will be key.
That's quite interesting. The other theme which is playing out in the market, Mahesh, right now is this renewed focus on PSUs, and especially PSU banks, led by SBI. After its earnings, it almost turned out to be a re-rating moment for the entire PSB pack. How enthused are you about state-owned companies?
So yeah, as I mentioned, value as a theme is working quite nicely globally, as I said, and also in India. and the best manifestation of value in India is the state-owned enterprises. Be it banks, be it utilities, or some other segments as well. But the thing is, many of the global investors, have stayed away from that space for a long period of time. Because of ESG concerns, etc. And I'm sure that some of those concerns are slowly getting addressed. And the fact that the government had stepped away from the ETF-based disinvestment, which was a big overhang for many of these PSU names, has definitely helped. The value theme has helped as well. So I do believe that some of these state-owned names will continue to do quite well. Some of the large banks will do well. We also quite like the utility space because that not only offers a high dividend yield but quite low PE multiples as well. And some of the company level strategic changes is helping improve the ESG ratings as well. So yeah, some of the PSU names definitely look pretty interesting.
Mahesh, the proof really in the pudding as to how the broader markets have managed to shape up, at least for the month gone by. That outperformance very evident vis-a-vis the frontliners. You've mentioned a whole host of individual sectors. What about opportunity within the broader market, and basically what your advice as well would be to investors to capitalize on this momentum?
Yeah, so I mentioned a few subsectors, already, housing, and related. Apart from that, we still continue to like the commodities, as a theme as well. We do continue to believe that the valuation in the steel segment, is still very attractive. And while the stocks have had a run, but I think the valuation still continues to be supportive. And I think, the support is coming from the Chinese supply side dynamics as well. So that's one space that we definitely like. And the large financials. So I'm still going to stick largely to the large private sector banks within the financials, because I still want to guard against being over optimistic, because some of the asset quality concerns or provisioning related issues might still crop up in the June quarter and September quarter results. So I still want to guard against that. So I'm still going to play the financials from the large private sector bank perspective. Also insurance as a segment is looking quite good as well. So there are various options and lots of good sectors. But as I said, one needs to be selective from the next 6 month to 12-month perspective, because I do worry that some of the global risk that we just discussed and the risk of rising yields in India will probably cap the broader market returns over the next 12 months.
Are you trimming earnings expectations for FY22 owing to the kind of restrictions on the second wave?
The earnings growth in FY22, should be pretty strong. I mean, obviously we have a low base helping us. Definitely for the broader market, we're looking at a 30% plus earnings growth for FY22, but that's already factored in. I don't think that 30% plus earnings growth for the current year is going to be any source of big excitement as such, because I think the market is already factoring that in. I think what the market performance will be dependent upon is how the estimates change for FY23. And for FY23, we are looking at the broader earnings growth to be in the range of 15 to 18%. So still quite good. And my sense is that there could be some small revisions on the downside after the June quarter results. But obviously, the extent of those potential earnings revision on the downside, could be lower because, as I mentioned, earlier, the economic recovery and the economic data points that we are tracking post the second wave are actually surprising, on the positive side. So the pace of recovery, is looking pretty good. Now the pace of vaccinations, have also picked up. So yes, so about 30% plus for this year and 15% plus for next year is what we are looking at.
All right, and when it comes to the global facing companies, particularly IT and pharma, what's the outlook? Would you continue to find or derive more comfort from the large caps vis-a-vis some of the mid caps?
Yeah, so IT, as a sector continues, to be interesting, especially when we're looking at the US GDP growth in CY21 and CY22 cumulatively is going to be almost 12%. So 2 years cumulative GDP growth of 12% for the US, as an economy. I don't remember, when did we see this type of growth? So that is, clearly an optimistic, thing for the IT companies, from the demand perspective. But having said that, one key thing that we need to keep in mind is that over the last 12 months, a lot of IT companies have benefited on the margin side, because while the revenues were coming in, because of the lack of travel, etc., a lot of costs were under control. But as the global, sort of economy opens up and, we get back to the normalization of travel, business, etc., in due course of time, the costs are going to catch up as well. So while the revenue outlook remains pretty good, I think there could be some, disappointments or maybe some revisions on the downside as far as the margins are concerned. So that is something that we need to keep in mind. But yeah, but having said that, we still like, IT space, selectively. Yeah, so that's what I would say.
All right. The way I see it, Mahesh, you've actually got quite a holistic view, value being the underlying theme, but clearly you've got picks across segments and, of preferred performers, of course, and, some of the heavyweights across segments. But it really is a more holistic portfolio that you're looking at. Is that the correct way to look at it?
Yeah, that's right. There are several opportunities, as I mentioned. Some of the things which, we are cautious on, as I mentioned, is consumer staples. That's a segment that, which is expensive, and the growth, trajectory or sort of, the upsurge that we will see, over there will be much more limited as compared to the other sectors. Consumer discretionary is also the other segment where we will probably, see some subdued trends. Telecom is the third segment. So I think these are the 2-3 segments, where, we are a bit cautious. But I think, broadly across like several sectors, we would definitely sort of looking to pick, stocks which offer value, because I think value as a theme, would still continue to play out.
Mahesh, how would you advise people to get rich? A lot of our young investors look forward to some strategic advice, and I know it's simplistic to give in a couple of lines, but if you had to, what would you say?
Well, I'm not really, into, advising retail investors, so to speak. But yeah, one kind of a simple word of advice, from my side would be that investing is a pretty serious business, and requires sort of definitely certain skills. And my kind of belief is that it should be left mostly to those who know it best, basically the investment managers. I know that many people, like to kind of, buy individual stocks. And while, some of those, can give kind of, great returns, but, my sense is that for an individual who has his or her job to take care of, one might not be on the top of, the latest development, so to speak. So I would say that mutual funds or the professional advice would still be the best way to go. Take the long-term approach, and I would say that one should be looking at investments at least from 12 to 24 months perspective, actually longer than that, if possible. So yeah, nothing sort of dramatic as such, but yeah, those are the simple words I would say.
Okay. Mahesh, have you managed to finish all those books behind you? Last time we spoke, you were still at it. What's the count like now?
Well, I do try to, take some, time out, and in the sense that, initially, obviously, the work from home, was, very kind of overburdening. But yes, over a period of time, I think everybody has learned to cope with that. So yes, I've been able to kind of manage, a few.
Okay. Great, Mahesh. Good to speak with you as always. Take care. We'll chat again soon.
Thank you very much. Thanks for having me.